Good morning. You're watching All You Need to Know on Bloomberg Quint Live, and I'm Alex Matthew. First, the headlines. Pakistan has downgraded diplomatic relations and suspended bilateral trade with India in response to a move to abrogate Article 370 and change Jammu and Kashmir's status to a union territory. Oil prices rose after hours trade on a Wednesday after sharp cuts during the day. Saudi Arabia said that the current drop in prices is intolerable and that all options are still on the table to improve the situation. Tata Steel's first quarter profit fell to the lowest in over 2 years owing to lower domestic steel prices and higher raw material costs. HCL Technologies missed its profit and margin estimates for the June quarter. However, it has maintained that its revenue and margin growth guidance for FY20. And Ultratech Cement is the only Nifty company scheduled to report its quarterly numbers later today. Let's talk about the US markets now. US equities and benchmark treasury yields mounted an impressive comeback late in the day, reversing sharp drops as investors turned more positive on the outlook for global growth amid central bank moves to ease monetary policy. Sue Keenan of Bloomberg News gets you the update of that session in this report.
It was a late-day comeback for stocks on Wall Street after a sharp decline. In fact, it was the third biggest recovery for stocks since 2017. The S&P 500 ended virtually flat after erasing an almost 2% decline. The Dow did end down about 22 points. The Nasdaq closed up about 30 points. Now, trade continues to be a main concern weighing on the market, particularly as many investors and analysts point out the trade concerns have already started to crimp corporate profits. In the words of one strategist, a lot of investors feel like we're getting ready to hit the wall because of the action on the trade war. He says he hopes that wiser heads prevail. Now, the standout stocks include CVS, a nationwide chain of drugstores, which saw its biggest jump in 8 years as it's raised its forecast. The stock was up 7.5%. Disney fell the most since 2015 as it announced disappointing theme park attendance here in the U.S. That has a lot to do with disappointment on a Star Wars ride. Weight Watchers soared 43% as the company beat earnings. The billionaire Oprah Winfrey, a big investor, is going to take a bigger role in commercials for the company. That helped lift the stock. And after the bell, Lyft was in focus. The ride-sharing recent IPO came out with better than expected results. Throughout the day, oil was in the spotlight. West Texas Intermediate, largely traded here in the U.S., fell as much as almost 6% and then cut its loss in half by the end of the day. A surprise increase in U.S. fuel supply tanked the prices. However, the Saudis announcing that they may act to defend price lifted oil, and after hours we are seeing a gain of better than 2%. Sue Keenan, Bloomberg News, New York.
All right, well, with that, let's turn to the Indian market and, just get set up for the trade and also see what's happening in the futures and options space. Darshan Mehta is here to tell you all about that. Darshan, it's been a weak couple of days, in fact, yesterday as well. Despite the positive start, we ended in the red. It's not looking very good across the board in Asia as well. How are we looking to start?
Yeah, so basically across Asia, it's decent. It's not that bad as compared to what we've seen. The US markets were also stable. Yeah. Yesterday, despite a positive commentary from the RBI, the Bank Nifty managed to move up and then they collapsed suddenly at the end of the day. So there is weakness. The SGX 50 is not indicating the worst of starts. Yes, it's down 13 points. So that doesn't probably give you the confidence to trade in such markets. We had the 10,800 mark. Yesterday, the Nifty was down 100 points, but there was the mid cap and small cap end of the market also saw selling that came in. There was more selling on the Nifty Bank, and look at the collapse that happened on the Nifty PSU banking index, and that's on account of big sell flows that are there on SBI at this point of time. All the ADRs ended with a negative bias. Vedanta was down almost 3%. Tata Motors continues to bleed. ICICI, HDFC Bank also down in trade. The IT or the defensive pack is seeing a bit of buying. So Infosys and Wipro saw buying that came in. Dr. Reddy's was flat in trade. So that's the ADR picture for you. Now, how did the flows pan out? FIs were net sellers, DIs were net buyers. So there is heavy FI selling that's happening across the board. If you're looking at some of what happened with the Nifty was down 90 points. Reliance is down almost 20%. 1% from the peak. So that's one of the key reasons. ITC, SBI, Axis Bank. So these were the counters. SBI and Axis Bank especially, as well as Reliance, were the one that were leading the rally on the Nifty. They have actually given way. What did well was Cipla, probably will react negatively today to the weak earnings that came out. Z, Infosys and HCL were the other counters that managed to lend a bit of support, but the heavyweights were down in trade. Now, what happened as far as the F&O markets were concerned? Clearly, there was long unwinding that was seen on the Nifty. Open interest was down almost 1%. The Nifty Bank was down over 1.5%. So there was selling, and that actually saw fresh shorts. Open interest was up almost 3% for the Nifty Bank. Now, what we're seeing is that at high levels, put writers are still active from levels of 10,700. Even at levels of 11,000, there is a writing that's happening, and we're clearly below that level. So, and call writers will become much more aggressive in trade as the market manages to move down. Yesterday was the clear indication. At every level, put writers had to shed positions because the markets was going down, their premiums were going up and they were losing money, and call writers were making significant amount of money in the market. Now, the other factor is the stocks in the F&O band and the PCR. Let's take a look at that. The VIX obviously at levels of 17, not the most elevated level, but since the market is volatile, the VIX managed to move up. The Nifty PCR now below the 1 level, given the fact that call writers are much more aggressive. Stock specific, India Bulls Housing Finance was down 13%. Weak set of numbers, weak commentary. The outlook is negative, so 15% open interest. Fresh shorts were seen on Birla Soft also. Among the counters, which saw either short covering on long unwinding, SRF for one saw long unwinding that came in. Max Financial also long unwinding that came in. Kajaria, Just Dial and Castrol saw short covering in trade yesterday.
Thanks so much for that, Darshan. Darshan was pointing this out at the start of his trade setup. He said that the Asian markets are not looking too bad, and that indeed is the case with the Chinese markets and, in fact, the market in Hong Kong opening up. Let's take a closer look at where those markets are trading right now. I'm joined by Sophie Kamruddin, who's joining us from the Bloomberg studios in Hong Kong. Morning, Sophie. Quite a lot of green on the screen, and that's a pleasant sight to see.
Yeah, this Thursday we are seeing Asian stocks head for a second day of gains. This as investors assess the global growth outlook in the wake of central banks providing more support with further easing from central banks in Asia. We have the Banco Central of the Filipinas due to announce its policy decision later today. It's also expected to deliver a rate cut. So across equity markets, we are seeing mostly green, with China leading that charge at the large cap CSI 300 index adding 0.9%. And we are seeing some decent price action in the wake of the PBOC setting the daily fixing for the renminbi weaker than 7 for the first time since 2008. So you have the yuan falling to the lowest level since 2015 against a basket of currencies, and the onshore rate against the US dollar that is gaining ground up about 0.25%. Now, when it comes to other assets of note, we have the Korean won moving higher at a 12.10 handle against the dollar, while the Kospi is up 0.8%. This is we get some optimism around the trade spat with Japan. We do have South Korea's Prime Minister confirming that Japan will allow some exports of goods to South Korea when it comes to those restricted materials. And elsewhere, we have the Nikkei 225 adding 0.5% as well, while we do have the yen just holding steady above that 106 handle against the dollar, while spot gold has reversed gains after the move from the PBOC, moving away from that 1,500 level that we saw overnight. But overall, we are seeing some big moves across asset classes. Also want to highlight oil. We have New York crude and Brent gaining nearly 3% this morning early in the Asia session, rebounding then as Saudi Arabia grapples with how to manage this slowdown in prices. Back to you.
Thanks, Sophie. And that is indeed what we're going to speak about next. We are speaking about oil. We extended a decline after Brent crude closed in a bear market on Tuesday, but it clawed back those losses, and it is up in trade as of now after Saudi Arabia contacted fellow crude producers to discuss ways to halt the slide in prices. Now, last I checked, Brent, which was only recently close to $65 to a barrel, was at $57.5 to a barrel last I checked. But Aaron Clark of Bloomberg News gets you all the details, all the moving parts that are leading to that price in crude oil.
Oil is rebounding a little bit today. West Texas Intermediate, the U.S. benchmark is up as much as 2.9%. It's trading right around $52, $53 a barrel. That's after Bloomberg News reported that Saudi Arabia is considering a policy response to low oil prices. They're in discussions with other oil producers. We don't really know any details beyond that, but what the Saudi official told Bloomberg News is that they won't tolerate low prices, and they're looking at policy responses. I mean, this is really significant because, Saudi Arabia is the world's largest oil exporter. They're really the de facto leader of this OPEC Plus group, which includes Russia. The group implemented, oil production cuts in the first half of this year that really helped prices, stimulate prices and helped prices rise and cut global inventories a little bit. They extended those cuts through the second half of this year, and clearly they're considering additional options. So I think everyone's going to be watching for any more news out of Saudi Arabia as they look to curb the decline in prices.
Aaron, Brent crude's fall into a bear market this week and oil's recent decline. It all comes back to the old story, US-China trade war, right?
Yeah, that's really overshadowing everything else in energy markets right now. Like you said, it's just this escalating trade war between the U.S. and China. Of course, the concern is that will impact global economic growth, which trickles down and impacts fuel demand, weakens fuel demand, and weakens oil demand. It's really overshadowing everything else, even though there's been a few other things that traders are watching. Of course, there continues to be tension in the Strait of Hormuz. Iran has seized several tankers there, so traders are watching that. It's really important for energy markets because about 1/3 of oil flows, 1/3 of seaborne crude flows through the Strait of Hormuz. So clearly, any tensions there could impact prices. But so far, traders are just shrugging off the tensions there so far. Another bearish factor that was reported yesterday: the U.S. government said that oil inventories expanded for the first time in 8 weeks. Gasoline inventories also rose, so that really suggests a weakening in demand in the U.S., weakening fuel demand in the U.S., so that's another bearish factor. But, like you said, overshadowing all this is the U.S.-China trade war and concerns of economic contraction and weakness for oil demand.
All right, let's have a look at what else is making headlines across the globe. Sue Keenan of Bloomberg News brings you the First Word headlines.
President Trump is once again bashing the Federal Reserve, firing a string of tweets calling for bigger and faster rate cuts. He wrote of, quote, incompetence when things can be dealt with easily, adding that the Fed does not understand that the U.S. is competing with other countries. He also says the Fed is too proud to admit its mistake of acting too quickly and tightening too much. The White House has traditionally not commented on Fed policy. China's top agencies in charge of Hong Kong affairs held a special meeting in Shenzhen to discuss the ongoing public unrest. The protests have become a wider challenge to Beijing and are raising questions about whether China will intervene directly. The seminar, included 500 invited representatives from Hong Kong. Oil, meanwhile, clawed back some losses after Saudi Arabia spoke to fellow producers about how to halt crude's recent slide. Prices fell to lows not seen since the start of the year as a surprise surge in U.S. crude stockpiles fueled new worries about a growing glut amid sinking demand. Oil has been caught in the meltdown of stock and commodity markets after rate cuts in New Zealand, India, and Thailand raised fears of recession. And tension is rising between nuclear neighbors Pakistan and India. This after New Delhi revoked 7 decades of autonomy for disputed Jammu and Kashmir state. Islamabad announced a series of measures to oppose what it called India's, quote, unilateral and illegal actions. This includes downgrading diplomatic ties and suspending bilateral trade. Pakistan says it will also take the issue to the UN Security Council. Global news 24 hours a day, on air and at TikTok, on Twitter, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Sue Keenan. This is Bloomberg.
All right. Well, the RBI yesterday, if you were watching markets closely, sprang a surprise on Wednesday. Not with the rate cut, but the rather unconventional quantum of the cut, which was 35 basis points. Now, the RBI governor made it amply clear that the RBI wants banks to pass on the rates that have been forced so far in 2019 faster to customers or consumers. SBI obliged cutting rates within 2 hours. Ira Dugal caught up with SBI's MD PK Gupta and Rajiv Anand, the wholesale banking head at Axis Bank, to find out what they made of the Monetary Policy Committee's decision.
Well, I think the growth has been a big concern. I think there has been a bit of a slowdown both globally as well as on the domestic front. So RBI has tried to address all the issues. I think if you look at the past few months, we have been talking about liquidity in the market, about the interest rate direction. I think what RBI has done is they have taken very conclusive steps in the recent months, which has led to liquidity being comfortable. On the SLR, LCR front also, I think now, by April 2020, most of your SLR will be eligible for the purpose of LCR also. So I think all the steps ultimately are probably leading to, one, on the monetary policy front, whatever RBI had to do, they have already done that actually. As far as the banks are concerned, I think the transmission was slow at the beginning. I think a lot of it is now happening going forward, given the current liquidity situation. I think there is a scope for maybe the rates to go down further, but obviously it will happen over a period of time.
Was this broadly what you had anticipated, and given the easy liquidity that Mr. Gupta was saying, do we see quicker transmission of policy now?
I do believe that this is actually a little more than what I had expected. I think there is an unambiguous shift, away from inflation targeting to targeting growth, and that RBI will do whatever it takes. My words, not the governor's, to ensure that we get. There is a concern as far as growth is concerned, and therefore we've got to cut rates to get growth going. And by and large, we're quite comfortable as far as inflation is concerned, is the basic hypothesis. And I think in that context, the fact that rates have been cut by what I believe is a funky 35 basis points is a little more than what the markets were anticipating. Could we have got 50? Probably, but I think here's a new game in town of 35 basis points. So one can't argue too much with that. And I think the point that you make about transmission, the one important point that I want to make to you is that up to June, liquidity was actually in deficit, and so therefore the ability of banks to pass that on, was that much more difficult. However, post June, the entire liquidity scenario has actually changed. We are now in 2 lakh surplus, and therefore the ability of banks to pass this on with lower deposit rates and therefore lower lending rates, I do believe will become much faster as we go forward.
Yes, I know that some banks have cut, for instance, the MCLR like you have. But what is the actual benefit that is going to the customer, given the fact that there is risk assessment changes also happening in the environment? So, for instance, for your customers, can you give me a ballpark number of the kind of reduction that customers across the curve would have seen on rates from since February, for instance?
See, this transmission is happening in 2-3 ways actually. So one is on the MCLR. Okay, so MCLR, whenever the new loans are originated which are linked to the MCLR, or the existing rates come up for refixing actually, so they get refixed at the new MCLR. So if you look at the maximum MCLR fixing is 1 year actually. So typically what we see is that over the next 4-5 months actually, so a lot of refixing will happen, and that transmission will get done on those loans. But what we have also done is that we have linked all our cash credit and overdraft accounts to the repo linked benchmark. Okay, so those are linked directly with the repo rate. So which means that whenever there is a reduction in the repo rate, and this transmission is happening immediately. So we have already cut rate about 50 basis points on that direct transmission has happened. So this 35 basis point cut which has happened today will get passed on with effect from 1st of September to all of our customers. So almost 20% of our loan book is actually linked to the repo rate links actually. Okay, so which means that a lot of this transmission is already happening.
Right, that's good news. You should actually check with your bank to ensure that that transmission does take place. But meanwhile, let's turn to earnings. HCL Technologies margins declined in the first quarter, hurting the bottom line. But the management is putting up a brave face as of now and has put up a revenue guidance of 14 to 16% for the full financial year. Agam Vakil caught up with the company's CEO and CFO and started by asking Mr. Vijay Kumar what hurt the margins in the quarter gone by.
So there were a number of factors that sort of delivered those numbers ultimately. First of all, the smaller factors but common factors with everybody, like visa costs, which are once in a year, Forex, which also gave a bit of a headwind this quarter. But apart from that, we had guided towards investment in the SG&A line and above in the direct costs as well, which is what played out. We were last quarter when we had guidance for the quarter, we had assumed that we would be able to close the IBM deal on May 31st. That got delayed by a month. So those costs are there almost in full, but waiting for the revenues to flow in, which they will start only from July 1st. So that has been a factor. Apart from that, in the ERS business, since we have broken it out as a separate segment, you will see that there is a reduction in margins in that segment as well. That was partly to do with some one-timers in the previous quarter, but also we are investing in a number of on-site centric deals, as well as investment in that business also, and some cost impacts which we are working to sort of reduce going forward.
Okay, so Prateek, I'm sure investors will be heartened to know that you guys have maintained your EBIT margins guidance because wage hikes are still expected to come into play for this particular quarter, in the second quarter.
That's right.
And at this point in time, for the first quarter, if I'm not mistaken, your margins stand at around 17.1%, which means that there is a little bit of leeway before you guys move back about the mark of 18.5%.
Yes.
Where is that going to come through?
So that is something we expect pretty much from the next quarter onwards. Two large factors. Number one is the deal revenue and margins flowing in. As we had guided earlier, that revenue comes in at a margin of 50% plus EBITDA. And that contributes in a big way. And also there are a number of cost improvement actions which are already underway, which we are sure will start delivering better margins next quarter onwards.
I also want your view on IMS, specifically the legacy business, because I'm reading in some reports that there could be some deflation on account of that. And the second part is, if you could also give me an idea about how financial services is working out for you all, because it's a very mixed picture when I've spoken to some of your peers out there.
So let me start with the infrastructure business. Since this quarter, we are not calling out infrastructure business as a separate revenue stream. It's integrated into the IT and business services segment. And because there is a lot of, as we have been talking about, there's a very thin line between infrastructure applications. There's a lot of integrated deals that we are seeing, which has infrastructure, application, and the digital process operations. So I can give you a qualitative commentary. Last 2-3 quarters, we've signed a lot of big deals, and that's kind of helped build a momentum in the infrastructure business. Even this quarter, we've signed some good deals. And the overall opportunity on infrastructure, I remain very optimistic. There is enough deals in the market. There are very few quality players who can take on a fairly complex infrastructure transformation and modernization and do well. And we are one of them. So we have a unique position, a good competitive advantage, and very high capability. And there is enough market opportunity. So I remain bullish. Cloud migration, while in some pockets it's going to be a headwind, but the overall opportunity of hybrid cloud and infrastructure modernization is still a good growth opportunity. So I'm pretty optimistic on that.
Okay, but about financial services.
Yes, even this quarter, financial services, though you see a sub 1% growth, but the growth has been more broad-based, and it's been offset by client-specific situation, which we've talked about earlier. We talked about 2 clients, but one of the clients is more or less stabilized and it is in a growth path. And another client, I think some of the challenges will continue for some time. But there are also enough transformation opportunities in these clients, and we are very happy to kind of work with them and support them in the journey.
Sticking with earnings and talking about Tata Steel, it reported the lowest profit in over 2 years due to low prices and the weak demand in the June quarter. Nikki Manchandani is joining in to tell you all about the fine print. Nikki, good morning, starting with the headlines.
Good morning, Alex. Not only the profits are at December 2016's low, if you look at the margins, they for that matter are at 7-quarter lows. Clearly, the street was estimating bad set of numbers, and they are pretty much in line with what the street was estimating. Revenue, look at that, top line growth there. Bottom line, we saw a dip coming in at 64%. EBITDA performance, that is down by 15.4%, and margins have shrunk to 15% as compared to 18% that we saw in the corresponding quarter. The volume growth picture, that was not encouraging either. We saw the sales volume consolidated basis at 6.34 MT and versus 6.02. Now remember, that was reported way before the results came out, and on account of that we saw the consolidated EBITDA per ton also slowing down by as much as 24% year-on-year basis, and standalone EBITDA per ton. However, the surprise came in from that number. The number came in, although was down by 20% at 14,218 rupees per ton, but it was way higher than what the street was estimating. We were working with an estimate of around 12,000 rupees per ton. So that's clearly a good set of numbers, at least on the standalone front. What has really weighed on the profitability of the company? We've seen lower deliveries, we've seen higher costs, and we've seen sinking steel prices. All of that put together has weighed on the profitability of the company. If you look at the segmental wise or the geographical breaker of how the numbers have panned out, EBITDA business, the Tata Steel on standalone basis, that has seen a 20% downtake. Bhushan Steel business, that relatively is not going to be a fair comparison because it's ramping up the capacity there. Sponge iron, where it's seen a 10% downtake, and European business, that's the pain point here and has been a drag on the financials for the company for a while. That number is 96% lower. A minute here, debt situation here remains to be a key cause of concern for Tata Steel as a whole. It's been a drag there. The gross debt has actually now stands at around 1,06,636 crore as compared to 1,18,000 crore that we've seen in the December quarter for that matter, or March quarter for that matter. The company, however, good part is that it has reaffirmed the $1 billion guidance that it held earlier part of the year, despite the slew of things which have not gone well, the Thyssen Group, the SEL termination, SEA, Southeast Asian business termination. What it essentially plans to do now to achieve this kind of guidance, it's already signed in an MOU for a Thailand business. The capex requirements that have been slashed by 25% is going to be focusing more on internal cash inflows to meet to this guidance, and it's expecting a better performance coming in the H2, which essentially holds the key for better performance coming in, or rather the company sticking out to its $1 billion target.
All right, now, Nikki, shifting focus to the one nifty company that we have today, and that is something that you look at. Ultratech is coming out with numbers today. What's the key expectation here?
We're expecting a fairly good quarter from Ultratech. If you look at the top line growth, we're expecting a 13% number there, growth figure. EBITDA 46%. Margins are expected to expand to 25% versus 18%. Volumes are seen higher by 8% year-on-year basis. That's a fairly strong number if you'd look at that, given the kind of performance we've seen from ACC and Ambuja. Realization, they are expected to inch higher, more than 4%. And EBITDA per ton, the key metric here, to kind of measure all the cement companies, and for this company we're expecting a 36% uptick there. We are expecting higher prices essentially, and the lower cost measures to hold up for Ultratech cement, given that the petcoke prices or for that matter diesel prices, there has been a benefit on account of higher axle load norms. All of that put together is expected to drive the operational performance for Ultratech cement as a whole.
Thanks so much for that, Nikki. All right, so clearly there are a couple of stocks that you need to look at very closely in trade today. Mishika Parak is here to tell you all about the other stocks that are in the news. Mishika, good morning. What's on your list today?
Good morning, Alex. Let's first look at the MSCI changes. MSCI adds HDFC Life Insurance to the Global Standard Index and deletes Union Bank of India from Global Small Cap Index. Now, these changes are as of the close of August 27th, 2019. Then we have quarterly results of HPCL. The results were below estimates and the miss would have been larger if not for the forex gains. The reported gross refining margin stood at $0.75 per barrel versus $4.7 per barrel reported by Indian Oil Corporation. They posted EBITDA losses in the refining segment on the back of weak gross refining margin and inventory losses. Marketing segment reported EBITDA which was in line with estimates, and PAT was boosted on account of the forex of rupees 200 crores. Then we have Aurobindo Pharma. The results were in line with estimates. Revenue growth was led by US and ARV sales, and API business was disappointing. Siemens India, again, results were in line with estimates. Revenue growth was led by mobility and digital businesses. The management says liquidity is becoming a concern in the industry with payments being delayed, and the board decides not to pursue sale of mobility, rail and mechanical drives business to its parent, which is a positive for the company. Phoenix Mills results were above estimates. Their revenues and EBITDA is up 49%. Net profits up 2.2 times and margins remain flat at 47%. Q1 was aided by higher profits in residential business, and retail performance was affected by one-offs. Now we have Reliance Industries. Tiffany & Company and Reliance Brands Limited today announced plans to enter the Indian market. For Gujarat Alkalis, operations of phosphoric acid plant at the H complex has been restored, which had been shut down on account of heavy rainfall.
All right, thanks so much for that, Mishika. Well, let's talk about some of the headlines that you'll find, or some of the stories you'll find on the website bloombergquint.com if you look up the website right now. First up, let me tell you about the top news. Pakistan's government said yesterday that it is downgrading diplomatic relations and suspending bilateral trade with India. The decision comes after a meeting held by Pakistan's Prime Minister Imran Khan to propose a legal, political and diplomatic response to India's move of revoking Jammu and Kashmir's autonomous status, according to a statement. Now, Pakistan resolved to take the matter to the United Nations and the Security Council. India, for its part, has said that Jammu and Kashmir is an integral part of India and the issue is strictly internal to the country. Now, there may be relatively little at stake commercially with this latest update. Bilateral trade between the two countries amounted to just about $2.5 billion in 2018. That was roughly 3% of Pakistan's total trade and only about 0.3% of that of India. Now, Donald Trump has stepped up his assault on the Fed, renewing his demands for bigger and faster rate cuts. He wrote in a series of tweets complaining that incompetence was a terrible thing to watch, shrugging off concerns about China. He also said that the United States was bearing the brunt of the Federal Reserve's pride and its unwillingness to admit its mistakes of acting too fast and tightening too much. That's all you need to know going to trade today. Do stay tuned. There's a lot more coming up in just a short while. This is Bloomberg Quint.